People think of investments, they typically think of risk, or they think that you need a large sum of money to get started, but that's not really true. The truth about investments are they all are differently associated with risk. Also, the startup cost of this can vary depending on what type of investment that you're investing in. The first type of investment that you probably heard from me a lot is ETFs. All an ETF is usually just a fund that is traded on different exchanges and that they specifically track a certain index. All an index is just something that they use to measure the economy. Common known indexes are basically portrayed inside the market when you get into brokerage firms or brokerage accounts are typically the Dow Jones, the NASDAQ, and the S&P 500. And a lot of people really know about that one. That's the most common one that people invest in. Buying an ETF gives you a bundle of assets, which in return diversifies your portfolio. They're typically seen as low-risk investments because of the diversification that it gives you. The benefit of this diversification is that it's a bundle of assets. So this means that you can have assets in different sectors. So for example, you have assets that are in commodities, and then you'll have assets that are in tech, and then some that are in real estate. So if one market is down, but the other markets are up, your ETF will still be in a growth phase because of the different assets in the different sectors. Another thing that ETFs are actually good for is that they have little to no startup costs. So you can start with as little as $1 and start investing between any amount that you're comfortable with along the process. What it is that ETFs trade like stocks. So with certain brokers, you're going to have a commission fee. And basically, all this is when you buy or sell, you get a commission fee on that. So if you were to go buy 2 shares and you had like a 2% commission fee and the price of the shares, we'll say $10 with like a small commission fee, you would pay more than $20 for the 2 stocks. Second on my list that I have for y'all is index funds. All an index fund is just a mutual fund that seeks to track the return of a specific index. So that could be, like I said before, the S&P 500, NASDAQ, or the Dow Jones. So they basically try to mirror the stocks that they have inside of those. Just like ETFs, they offer that diversification so that if one sector is down, the other sectors are up, you will still have passive growth. It won't be as much, but it'll still be growing along in the process. You won't have to solely rely on just the independent stock while you have multiple because, they're in different sectors. So if you had like just one sector and that sector was down, you would just basically, your portfolio would just plummet. Like if you had $1,000 and it was down 10%, you would lose $100. But if you had diversification, which are in these index funds, so say you had 3 different sectors and one was down 10%, your other part of your portfolio will still be up 90%. So you wouldn't lose 10% of your total account. So just like ETFs, index funds also have low startup costs, so it doesn't require a lot of money to get started, but they have expense ratio fees. So these are just small fees that they charge in order to make the money back for your money sitting. Ratios aren't really bad. They don't really take a big portion of your return unless you don't have a lot invested. The expense ratio returns are pretty small. They can be from like 0.7 and up, but typically they're really small, so it doesn't really affect your returns unless you don't have a lot of amount in there. So you should be fine on that if you do decide to invest in index funds because of the expense ratio shouldn't be that high. And if you do see an expense ratio that is high, you probably shouldn't invest in it because it will probably take over your returns, and you don't want that to happen. I got for you guys is CDs, or as we call them, certificate of deposits. You probably learned about these when you were in high school because they were taught in personal finance. I remember learning about them when I was younger. So this is probably one that's most common to people, but it's like an old tradition of saving. So CDs are just a time deposit that are sold by banks. So I don't know who you guys bank with, but if you go into your banking information and you go to like your applications, you'll be able to apply for a CD. All this is just giving the bank money, and they're just assuring you that after a certain amount of time, they'll give you the money back with interest. For example, we say you get a CD at 6 months and they say that we'll give this back to you with 2% interest. So you'll give them however much money like the CD is worth. So they have different amounts, so they vary. So they're typically, you can start off really low, but they can go up higher. But a lot of people don't invest a lot of money in it. Well, I'm not gonna say they don't invest a lot of money, but if you were to get a CD, you would probably want to invest more money than a little because the interest rate on it is just so low, you're not gonna make any money from it. So for example, if you had $100 and it was a 2% return for that CD, you're only gonna make $2 off of a CD for like 6 months or a year. It's just pointless to do that. So while these are low risk and they're not bad investments, I know you guys heard this saying low risk equals low return. So with these type of investment, they're low risk, but they also offer little to no return. So they can be good investments as far as like for emergency funds or like just having some money just sit, but as far as long-term growth and wealth, they're not really beneficial for you. One that I got for you guys is similar to CDs, but they're called bonds. These are literally the same exact concept that CDs have, except they're issued by governments and corporations to raise money. For example, in your city, if they were trying to like build a building or something, or like school or something like that, they'll ask people to lend them money and they'll agree to pay it back the same as a CD with a fixed term. As I said before, while these are low risk investments, just like a CD, they have a low rate of return. and they also include risk just like a CD does. That goes with bonds. It's kind of like the same thing as CDs, but it differs a little. With CDs and bonds, the risk of both of them, well, I won't necessarily say the risk, but the cons of it is that your money is just going to be sitting for that prolonged term and you can't withdraw it without a penalty. So that's really the biggest cons of having CDs or bonds, is just sitting money. Risk with bonds, though, is that these these corporations or the government could default on one of your payments. And what this means is basically say, we're not going to be able to pay at this time because we don't have enough money, or situation happen where they stop, whatever they're doing, they just stop. So if this happens, there's a chance that you could literally lose all your money, or you could lose part of the money that they were supposed to pay you. So say like you had an upcoming payment, but they said we're not going to be able to pay it. So they defaulted on that payment. So now you don't get that money for that month. So now you're missing out on that. So you lose that. But then it could also go to where the whole corporation or whatever they were doing just all shuts down. So all the money that you put into there, you just lost basically all of it. You take when you get bonds. Now, is this likely to happen? No, but at the same time, it's the risk that you take when you get into bonds, but it's not really common to happen. It's not something that you really hear about. Same thing as like with CDs, they run the risk of the banks failing. So that's something that's not common to happen. But if you just look back like at just a couple months ago when all the banks failed, that would have been the worst time for anybody that was into CDs, because all that money that they had would have just disappeared. So, like I said before, you run the risk of doing that, and you just take into the example that event that just happened, it kind of has people on edge about really investing into banks. So that's just something to take into consideration. Now, bond startups do vary. They can start off low, but a lot of them start off at typically a large, not a large sum, but like a certain amount. So some of them start off like 1,000. They have like minimum rates that they start off at. So you can probably find some, but a lot of them have, like I said, minimum startup rates. So they want you to minimum deposit $1,500, like $2,000. And like I said, a lot of people don't have that type of money to do that. So it would be better off if you were to go get a CD, because they're kind of like on the same, interest yield return rate. But at the same time, bonds or with government corporations, it just depends on whether you want to go with your bank or you want to go with a corporation that you think is going to give your money back. Third on this list is one of the most common that most of the population in the U.S. use, is a high interest savings account. And I've talked about this multiple times before, why it's not beneficial. But I'm going to break down really like why it's really not beneficial, like the pros and cons of it. You guys know a high interest savings account is just an account that you open with any type of bank. You can go to any bank, but most of these banks are online, so that creates a problem for some people. But typically some of them have high interest savings account and they have physical banks. So, you'll be fine with that. Some of the pros of this is that you can access the money whenever, because like I said, it's a bank. So you can withdraw the money, you can take it out. You can do this without having any fees. And of course, you have a higher yield interest than a regular savings. Like I told you before, a high interest savings, you can, right now with inflation, they're really low. So they're just around like 1%, which seems very low, but it's compounded daily. So the amount that you put in there is compounded on that. So it's not that bad, but at the same time, it's not a long-term growth type of thing. So if you're looking for a generational wealth, improving your income is not something you would typically invest in. Like I said, this would be something more so for like an emergency fund, or just to have like money build up slowly over time. If you did want to keep money inside your account, I would prefer that you would keep it inside a savings account though. And the only reason I say this is because the regular savings account, when you go and open an account, they give you a check-ins and they give you a savings. But the savings account that they give you on that one, the interest rate on that is like 0.02%. So I'd rather you have a 1% interest return than have a 0.02% interest return. You'll be making more money off of having that 1%, and it'll also be compounded daily. So you'll just be saving more money that way. So it's the better route to take if you want to just have money that's just sitting inside like an account just in case you need to pull it or withdraw it or something like that. Account is also FDIC assured. So for those of you who don't know what that means, it means basically when you open an account with, the federal government or anything, like not the federal government, but like a federal account, they insure you up to $250,000, which means like if you have $250,000 or like $1,000 in your account, it's supposed to be insured. So if anything happens to that money, they'll give it back. That's what the FDIC means. Cons of having these though, like I said, is they have low interest rates, so you're not really getting a big return. And then they also are subject to change the interest rate at any time without, telling you or anything. They don't have to give you a notice and say that, yeah, we're going to just change the interest rate from 2% to 1.5. Like, they don't have to notify you about that. They can just do it. So if say you had like an account and you was getting 2% interest and then it just automatically just flips, you're like, dang, now I'm not saving as much money because now it's gonna flip. So it's not a consistent ratio of you getting the money at that same interest rate, because it can change at any time. So that's kind of another bad con about it. And then another thing is you have a certain amount of times that you can withdraw from this account before you receive a fee. So typically what I've seen is like you can withdraw to like 6 times before you get a fee, which I feel is plenty. That's enough withdrawals that you should have for a month. You shouldn't really be withdrawing from a savings account anyway, because you're trying to save money. You're not trying to pull it out. So I don't really feel like you should have to withdraw 6 times unless, everyone has personal situations going on. So I feel like that's where they say 6 times. The last con that I say about it is, since it's such a low interest rate, if you were to try to use this for like wealth-wise, like I said before in another video, inflation rate is like 2.7 or 2.8%. So if you're trying to use a savings account as like a backup plan, so where you can save your money, if you only have a 1% interest on that savings account, inflation is still, overpowering your money. So it's still depreciating. So like I said, you can use this if you're trying to build like an emergency fund or like stack your money up a little bit, but it wouldn't be something that's used for generational growth or like wealth. So on this list is one that's really common if you're an employer, not an employer, but if you're an employee, everyone uses this. It's called a 401k. Those of you who don't know what it is, it's basically just an employer sponsored pension. So what I mean by that is like a pension is something that you get after retirement. So after you retire, they agree. So like it differs for different jobs. So some have pensions where they just give you a full payout, and then some have pensions where they'll pay you out, or you'll just get that certain amount of money for the rest of, for the rest of the time of your life, basically. So some people, it varies, the amount varies depending on your position, where you worked at, but a lot of jobs have this. A lot of military people get it. That's where, after they retire, they've been a veteran or something like that, they'll be earning money after they're not even in the military anymore. That's basically like a pension. 401ks, they're typically seen as low risk. Another thing is the money that's taken. So when you get a 401k, it's basically just a contribution from your paycheck. But the good thing about this is the contribution from your paycheck is deducted before they take taxes out. So it's basically your pre-tax money that gets taken out. It's not your after taxes. So I mean, that's the benefit for it. It's pretty good, You don't have to worry about taking money out of your check that's already been taxed down and then taking money on top of that. So that's a benefit to it. The benefit that a lot of people like about it is the amount that you put in. So say you're contributing $100, your employer will match up to what you're putting in. So if you're putting in 100, they'll match you and put in another 100. So basically, like every month, not every month, but like in the long run, they'll basically match up to the amount that you put in, up to a certain extent. You look at it this way, it's like, yeah, they're giving me free money. So that's why a lot of people like investing that way, but it also has its cons. One of the biggest cons of it is that you have to wait until you're age 60 to remove it. And that, to me, is terrible. So you have to basically go to a company, you have to work for them, and then you have to wait all the way until you're 60 to withdraw all this money. So it's just like money just going to be sitting, waiting for you till you're 60. And, anything could happen upon that time. You never know, but, Lord forbid, but, you have to wait till you're 60 to withdraw this money. So along with these, it's a low startup cost. So you can invest, like the amount that you take from your check is really dependent upon you. They do have certain amounts, but it's not like a crazy amount. It's probably be something like 10% or like 5% of your check, It's nothing that's an outrageous amount. So it's really small. So like I said before, you have to wait till you're age 60. So if you do decide that you wanted to pull this money out before then, some companies would allow you to do that, but there's a lot of companies that don't. But the ones that do allow you to pull it out, they pull it out on like a loan. So when you do that though, you can't, if you decide that you want to quit the job or, you just want to find another one, you have to pay that money back. So, and if you don't, they tax it, which is horrible. So imagine you pay pre-tax money, which is before they tax your check, to put that money into there. And to put your money basically into the 401k, and then you pull it out, and then you decide, oh, I'm gonna switch jobs, and now they're taxing you. So now you have to take your money that's after your taxes and pay that back. It's something you want to avoid. Most people, when they do 401k, they plan on staying with the job anyway, so that isn't really a common problem. But that's something, if you are trying to invest into a 401k as like a safer investment, you should always realize that you're not gonna be able to pull that money out. And if you do decide to pull that money out, that you shouldn't leave that job before, a certain amount of time, because they'll try to tax you on it. Last but not least is the last con that I say about this, that a lot of people, they know about it, but what they do is they take the money from your pre-tax, but like once you get 60 and you do withdraw the money, they tax all of the income that you have inside of there now, which is crazy to me, but that's what they do. They take the money from the pre-tax and then they put it into your investment account, which is your 401k. And then once you get 60, you have to say, okay, it's time to withdraw. Now, when you withdraw, they tax all the money that's in there based on the amount. So if it's 100,000, and typically the tax on it is super high. It's like 20%. So if you got 100,000 in there and they taxing it 20%, you're getting taxed $20,000 on the money that you invested. So like I said, it's not a bad investment, but like I said, you have to wait till you're 60, and then when you hit 60 and take the money out, you're getting taxed on it. So I mean, it's a beneficial one because it's with an employer and they match up to the amount. So if you are, contributing a good amount and then they're matching the amount, you're gonna have way more than that over the course of, like I said, you have to stay with the company for a certain amount of years, and which typically I think the ranges just for you to be able to withdraw, they're actually low. There's like 3 to 7 years. But if you look at it from a time span, it's kind of a lot at one job. But if you plan on like this a career path, probably gonna stay at that job, 10, 15, 20 years. So if you look on the long run, the contribution amount, you'll have more than that, but they're still gonna tax at 20%, which is, like I said, still a crazy amount. Next on this list is the other side of a 401k, what we call a Roth IRA. This it's essentially the same thing as a 401k, but with this, it's tax-free. The only difference between the Roth and the 401k is that the 401k, like I said, it takes your pre-tax money. With the contributions with the Roth IRA, it takes your after-tax money. So you would have to pay for it after they tax your funds. So and on top of them doing that, the contributions that you put in, they aren't matched like the 401k. So that's the downside of it. But the upside is tax-free. But just like the 401k, you can't withdraw before you're 60. But if you do, like I said, with the certain employers that do allow you to, you're withdrawing it tax-free. You don't have to worry about, that paying back. Well, the paying back part, if you do switch companies, it's kind of like the same thing, but you don't have to worry about, when you retire or something, when you take that money out, it's not taxed anymore. It's just tax-free. So everything that you did invest into it, it's all yours, but it's not matched how it was in a 401k. The last con of this that I'll say for this one, I don't really see it as a con because a lot of people don't make this much money, but there's a limit cap to how much money you can make so that you can invest into a Roth IRA. I mean, the amount that you can make as a single filer is like 140,000, and then for joint filers, 280,000. Typically, the people's salaries, I mean, I'm not saying that they don't make that much money, but your average person isn't making that much money. So, most of the population can invest into a Roth IRA unless you're making that amount of money. So that's just a con of that. One on this list that all of you have heard me talk about multiple times is stocks. So like I said, with the saying that I said before, low risk equals low return and high risk equals high return. Stocks is the riskiest investment that you can take. Like there's nothing that's higher in risk than trading, than trying to get invested into stocks. Again, stocks can be very beneficial investments, especially if you invest into the right companies. But there's also the high risk part of it is that, say you invest into a company and then that company just tanks. Like you're going to lose so much money because it's just an individual company. It's not a bundle of assets, it's just one single asset. So if you were to just, for example, you just said, I'm just going to invest in Apple and that's going to be my retirement investment. Say you invested in Apple and you invested, we'll say out of the course of, your retirement plan, you invested, we'll say 100,000, right? But instead of Apple staying at the price, we'll just say, I don't know what it is at right now, but we'll just say it was at like $75 per share. And in a couple years, it tanked all the way down to $20. So for every share that you had, you would lose $50. So if you invested 100,000 and it went down $50, you would basically get the number of shares that you had and then basically times it by the amount that it is now and then subtract that from the $70 that it was at. So you're going to lose a good amount of money if you were to do that. If you know math, you're going to lose a good amount of money. But there's also the chance that you could make a lot of money. Apple could go from 70 and then, over the course of, the time of your retirement, when you are about to retire, it could go up to 120. You know what I'm saying? So like if that happens, then you would make $50 extra per share and you put 100,000 in. So you look at it that way, it's like, yeah, you can definitely make money off of that. I just invested into individual companies. So if those companies just go down, you just basically lose all your money, but you also run the potential of those companies going up and you gaining money. But it's just individual stocks. You could lose money, you can make money. There's just a high risk of it. It's like, it's not even, you could say it's a 50-50, but at the same time, if you invest into a company that's not really known, they're most likely going to tank. So a lot of people, if they do like individual stock investments, they like to invest into those blue chip companies, like I said before, like Amazon, Tesla, Microsoft, companies that have been along for a long time, and they feel like they're going to keep going up in the process over time. So those are just companies you would try to invest in if you were doing stocks. But like I said, you also run the risk of those companies plummeting and you losing all your money. So without that diversification and just those individual ones, you run the risk of losing a lot of money. And the startup of it is, well, if you're targeting blue chip company stocks, the startup of that is going to cost a lot of money. Just individual, like right now in our generation, because the prices of it are so high. Like a share of Amazon right now is probably running like $109, and then share of Tesla, I don't know if it went up or went down, but that last time I looked at it, I think it was probably like a couple of days, not even a couple of days. I looked back like a couple months, but it was like at $200. You know, it might not be at 200, it might be like 179, 160. But if you're looking from a money standpoint, you know, 160 per share, you know, a lot of people don't have money to be investing at like every week or every 2 days, every day. You think about it like that long term, you know, if it's going to go up, you're going to pay more per share. So like I said, $160, 10 shares just of that is, you know, $1,600. A lot of people don't have that type of money to be investing. So, I mean, like I said, startup costs can be low, it could be high. It just really depends on what you invest in. But if you're investing into companies that you feel have the potential to grow, it's not going to come cheap. So that's something to think about if you want to invest into stocks as well. If you guys learned something new about investments and how they work, you know, the pros and cons of them, the startup cost of most of them. There are more out there. These are just some that I've just gone over in this video. But hope you guys learned something, and I hope that all of y'all have a nice and blessed day, and I'll see y'all in the next video.